Hello everyone, welcome back to my lecture series on strategic management and we are in chapter 3 where we are discussing about business policy and strategy formulation. And in the first two videos we already discussed what is business policy and then what is the process for formulating the strategy by knowing the definitions of mission, vision, objectives and goals. In this third chapter, we already discussed what is corporate strategy and what is business strategy. And in this video, my focus is more on functional strategy. Out of this functional strategy, we will discuss more about finance. Okay. Earlier, we discussed what is corporate strategy, what are the types of corporate strategy, and what are the key decisions will be taken under corporate strategy, followed by business strategy. What are the types of business strategy, and then what are the key decision or a priority areas in business strategy? And also we discussed corporate strategy versus corporate business strategy. So now we focus on functional strategy. Functional strategy is a bottom level strategy. So we saw in the hierarchy like business corporate strategy is the first level, followed by business level strategy, and then the strategy of a strategy for each of the functional department. So functional strategy refers to how manager will manage a particular functions of a in a company. For example, finance manager, how they are going to manage finance activity. Same way, marketing manager or HR manager or head of HR, how they are going to manage their function within the company. So every firm or every entity should achieve their strategic objectives. For that, every function should work towards the same strategic goals. And this functional strategy helps in achieving strategic goals. Okay, so these functional strategies are developed under the umbrella of business strategy as well as corporate strategy. So the topmost layer is corporate strategy, followed by business strategy, and then under that, functional strategy. So there will be multiple functional strategies based on each of their department. Sorry. So let's see first finance, and after that we will cover one by one. Finance is one of the biggest decision-making area in the organization. So as marketing also, then we will touch upon logistics, manufacturing, and other functional areas. Finance strategy. So money is one of the four M's which company requires to run the business. And managing finance well is most one of the important tasks of every manager. And generally, finance department is headed by CFO, Chief Finance Officer. And key strategies what he makes or what she makes in the organization are related to these eight broad categories. And also, we will talk about few finance strategic decisions within finance also. Okay. The first and foremost is cash flow. Okay. Let's do some blackboarding. There are two things in cash flow. What is cash flow? Cash flows are nothing but how much money is coming into the company, cash inflow, and then cash outflow. So this one, cash flows, cash inflow, which is coming in, cash outflow, which is going out of the company, will show the stability of the company. How stable is company? Because whenever your creditor comes in, you have to make a payment. When creditor is due, so you have to make payment for that. Whenever loan interests are to be paid, then you should be paying it. Whenever you purchase something, you have to pay to your creditors. So all these things will happen only if you have a solid cash flow. You can declare a dividend, right? So various things are there. So cash flow should be managed properly. This is one of the strategic decision for every company. So there are two things within a cash flow. One is working capital management, working capital, and the second one is long-term capital. Okay. So what is working capital? Working capital is difference between your total current assets minus current liability. So working capital is required for managing day-to-day obligations of the company. Okay. Current assets includes, you guys know already, I don't want to teach the basics of accounting here. Current assets includes your current assets, right? Current assets includes, one second, let me clear pen marks. Okay. So cash flow. So we are talking cash. Why do we need cash flow? Because of stability. We discussed this. And now cash flow, there are two things. One is working capital management, and the second one is long-term capital. Working capital management is for day-to-day operations. It is for key investments. Okay. What all covered in working capital management? Current asset, working capital management, working capital is equal to current assets minus current liability. Current assets includes your stock, inventory, your debtors, cash and bank balances. Key current assets, there are few more. Just I'm not getting in detail on this. Current liabilities includes your short-term loans, the loans which are due within 1 year, and then creditors, bills payable, here bills receivable on asset side. Okay. All those things, company should maintain proper working capital balance. We know that if working capital is more, means current asset is more compared to current liability. So then company is called as having good liquidity position, because whenever due comes, creditor dues or a interest payment or anything, so with the current assets they can pay it off. So it will help in smooth running of the business. So every finance manager make a decisions about cash flow process. Moving on. So we discussed it is for financial stability. So long term for future investments, and then working capital for day-to-day operation. And then they also plan for seasonal requirement. If your business is in a seasonal business like sugarcane industry, or for a simple example is umbrellas. So umbrellas will get sold only during monsoons or even sometimes in summer. So your product demands if are seasonal, then companies have to arrange higher cash flows during those seasonal periods. Or if you are in a retail during festival seasons, their sales will be more. So in that time, they need more cash to buy raw materials before that. So all these seasonal cash requirements will be managed by finance team during finance strategy. So finance strategy covers the first foremost important thing, free cash flow, followed by economic value added. The second other finance strategy is economic value added. So always finance department means there is some impression that it is cost to a company. Okay, but it is not that. Finance department also will provide required information, guidelines, other things for increasing the wealth of the stakeholders. They also help us taking decision about what product to be manufactured, what is the profitability of the company for each of the product wise. They provide all the required information for taking a proper business decisions. So with that, the net income minus operating cost will be more for a company, economic value add, and it also improves proper resource allocation in the process. Clear, guys? So second decision, second finance strategy is all about providing providing information to everyone for expanding the business. Everyone means key stakeholders, whoever takes the decision, to take a proper decisions to expand the business, by which economic value add or profits of the company will increase. And also it helps in proper resource allocation. That's the second strategy which finance team will be planning it during a finance strategy making process. Then asset management. One of the important expenses in any organization is an investment in assets. So, especially for a manufacturing company will be investing in huge machineries, and better utilization of those assets will become more and more important. At the same time, companies have to maintain one is on a long term, the machinery management, and the second one, they have to maintain proper balance between current assets and current liabilities, which will provide proper cash flow for managing the entire assets. So with that, company finance managers will be providing how performance is happening in other companies. They can do benchmarking and provide required information for decision making. The fourth one is capital structure. We talked about this. Okay, capital structure is another important decision. Any company's overall capital required to run a business is divided into two. One is equity capital, the second one is debt capital. Okay, what should be the proper best ratio for companies to run? 2 is to 1 or 1 is to 2. Like, they should maintain proper relationship or a proper ratio of equity and debt. More equity is also dangerous, more debt is also dangerous. If it is a more equity, then there is a volatile market. So many people will be there in market. So they will be buying or they will be selling it. There will be volatility. There will be there in a marketplace. If a more debt means it is going to be increased interest payment. So it increases more expenses. So that's why maintaining a proper capital structure for a company is important here. Otherwise, company will end up having higher cost of capital, KE. So that's why company has to maintain proper capital structure decision. So if a cost of capital is higher than other industry standards, then company's finance manager will think of reducing cost of capital by way of switching between equity and debt capitals. The other strategy, profitability ratios. Finance manager's job is to measure how operations are happening in a company, what was targeted, and profitability ratios. Right? So always there is a target which is given to organize to the particular department, and after like couple of months there will be actual results. It is a duty of a finance manager to accumulate all the actuals against targets. So target is producing 500 cars with a cost of 5 lakh per car. Okay, this is my target. So actuals maybe they have produced 450 cars with 5 lakh 50,000 per car. So accumulating this and planning this all are part of finance strategy. Okay, followed by growth indices. Growth indices are like companies will be measuring their performance not only on the basis of profit, okay, but also on the growth side. What is my sales? what was my sales last quarter and current quarter, last year, year on year comparison, quarter on quarter comparison, month on month, how we are performing month on month, and also how my competitors are working. All these things are part of finance strategies under growth indices. So they will compare quarter on quarter performance, year on year performance, month on month performance, what competitors are doing. All these things will be studied as part of finance strategy, and the relevant strategies will be made. Then risk management. My dear friends, risk management is one of the important areas in the recent times where every management is focusing on it, because as businesses are growing and there is a borderless business environment now, so there are a lot of risks which are welcoming into a business. It is not easy now because something happens in US that will impact business in India. So we should be well prepared. Something happens in Europe, again it will depend impacts business in India. Something happens in China, again it will impact. Somewhere some war happens, that will impact India. So it is all well connected now. Every incident, what happens in the global. So these risks should be studied. Risk is all about uncertainties, which will cause negative impact on my profitability. Okay, so risk is all about the external factors which are going to have negative impact on our profitabilities. So analyzing risk for every item. So proper risk management is important. So how the risk management process starts? It is by analyzing risk management. So the risk management process starts with analyzing the risk. Every process, every process within the business will go through analyzing the risk. Every decision for that matter will go through the risk. If a company wants to start new business in country B, okay, say for example in Qatar. So then it is a duty of a finance manager in association with other managers to do a proper risk assessment. So how is political condition there? Okay. How is economic growth in that country? So how is legal environment in that company? And then come back. Okay, what are the risks in each of these areas? Analyze those risks, then list the risks. How many, like, what all are the risks in the country? Then plan for mitigation, minimize the risk, mitigation plan, and then control, keep controlling it, control and evaluation. So it is very, very important for any decision, whether to start business in country or introduce new product, okay, or your day-to-day operations. There is a lot of risks. So that's why there is a concept of risk-based audits, okay. So all these things are part of risk management, and the relevant strategy will be made under finance strategy. And then finally, a tax optimization. Basic, one of the important functions of finance, if you see finance and accounts, there are few key functions within finance and accounts. First one, simple recording of transactions. Then second one, making statutory reporting. And third one is tax audit, tax management. Then there are many other functions. Okay, these are the basic functions of a finance and accounts. So tax management plays a greater role because Companies will be paying tax when they purchase the material, and they will be collecting tax at the time of sales of material, the net it off, management of GST, management of company's income tax. So it is a direct tax here, and then this one is a indirect tax. So this is most important aspect of a business. So with managing a proper GST and also proper income tax, so company can get more savings and which will reduce indirectly a total cost of the company. So in that way, tax management is another important strategic area for every business area, every business unit. Yes. So these are the finance strategies which will be made during finance strategy process. So free cash flow, economic value added, asset management, capital structure, profitability, growth indices, risk management, and tax optimization. So you guys need to remember what exactly these things and what are the key decisions will be taken under each of these items. Moving on finance side, there are some strategic financial management decisions which are having a long-term impact, whatever we discussed earlier, but these are the major decision points. We talked about investment decision. There are two. One is long term, and then second one short term. Okay. So every finance manager will take decision on investment aspects, which is very essential to get a proper return on investments. So that's why investment decisions also will help in not only a profitability, also a liquidity positions of a company. Liquidity position means company's strength to repay the loans and debts. Okay, so as long as there is a proper cash inflow, then only they can maintain all the obligations or financial obligations. So that's why long-term investments is all about capital budgeting, in which project we want to invest, how much money is required for that, how to get that money. All those things are part of capital budgeting. Which investment is more profitable, that will be part of capital budgeting. The same way, day-to-day operations, working capital management, where life of the cash flow or inflow or outflow is less than 1 year. So that will be part of working capital management. This is the first set. Second set is financing decision. Financing decision is all about your capital structure, how much debt I should have, and how much equity I should have in a company. Why it is important? Because it is all about cost of capital. Okay, my cost of capital should always be less than industry benchmark. If it is more, then we have to restructure our debt portfolio or equity portfolio. So we have to calculate. So finance team will calculate cost of capital, compares with the industry benchmark, and then they take a proper decisions. So the overall outcome of finance decision is reduced cost of capital and having adequate capital to run the business. Clear, guys? And third one is dividend decision. So dividend decision is very important. Dividend decision. What is dividend? Dividend is when company earns some profit in the year end, that will be distributed to shareholders. Shareholders, one shareholders, two shareholders here. Company will be having, say for example, if company earns a profit of 1 lakh, then they declare dividend to their shareholders. They don't declare this entire 1 lakh to a shareholder because They keep it certain portion of this 1 lakh, say for example 70,000, and they invest in business directly, and 30,000 they declare it as a dividend. So how much should be keeping it within a business? How much it should be declared and send it to shareholders? So this is a key decision for any business, because if you make a more dividend, then company may require to buy some debt. So company may take some debt to meet other obligations. Otherwise, if they reduce the dividend, company will get some funds in hand, so that can be used for business growth. So dividend decision is one of the important decisions within finance area. So three strategic decisions which finance management will take: investment decision, which includes capital budgeting and working capital management; financing decision, which includes capital structure and cost of capital; and then finally dividend decision, how much dividend should be paid, how much should be retained for the future use within the company itself. So dividend is a internal generation of capital. Sorry, the amount whatever is retained after paying the dividend is internal generation of capital for company. That's all about financial strategies. Be prepare that, okay, the financial strategies includes cash flow management, economic value added, asset management, capital structure, profitability, growth indices, risk management, and tax optimization. So key financial strategic decisions are in financial decisions includes investment decisions, financing decisions, and dividend decisions. Investment decisions, which includes capital budgeting, which is a long-term investment plans, and then working capital, which is short-term plans. Financing decision, basically about debt and equity capital management, and then capital structure management, and then reducing the focus is on reducing the cost of capital. Finally, the dividend decision, how much dividend should be declared out of the profit and how much should be retained for future use of the company. So this is all about financing strategy. In the next video, we will talk about marketing strategy.